Hi, my name is Darren Joseph from HEJ.tax, and we're the team that seeks to demystify that sometimes confusing world of international tax. And today we have the honor and privilege of having a great conversation with Melina. Melina, please introduce yourself.
Thank you, Darren. Thank you for inviting me. My name is Melina Mafridu. I am a German tax advisor and certified advisor in international taxation. So I mainly advise clients who have cross-border issues, private individuals, but also companies, corporations, and so on. Always with the viewpoint of avoiding double taxation and, of course, to give the best structure for my client. And I'm thrilled that we talk today.
Great. Can you talk about the exit tax? How is it triggered, and is there any opportunity to plan around that?
We have, different rules that triggers some kind of an exit taxation. I think one of the most popular is that you are holding shares in a company, for example, a GmbH or a limited, or it can be also a US LLC. But the US LLC is a bit different. So the US LLC, which is treated as a corporation here in Germany, then we have this rule that at the moment you move away, Germany loses the taxation right, and therefore the tax law assumes a fictitious sale of the shares. There are some other conditions for this rule. You must be living in Germany 7 years, the last 12 years, and so on, and having a minimum of 1% shares in the company. There are some other minor rules. I think I have a good blog article on my website if someone is interested to get to know a bit more. But
what's your website? Just in case someone wants to take a deeper dive, could you give your website?
It's international-tax-consulting.com.
Fantastic. Thank you.
And this exit taxation applies, meaning that there is a fictitious sale. Then we need to evaluate the company shares, which can be also sometimes a bit challenging because sometimes there might be also investors involved and you don't know really if the value of the company. Then, of course, the sale is calculated as the value of the shares minus the acquisition cost, and that would be then the taxable income, which is taxable at 60%. But at the end, if you just want to have a ballpark, it's like 30% of taxes of the sale proceeds that you have to tax in here in Germany, which can be really a lot because the problem with this is that it is a fictitious sale. Because usually if you sell a company, then you can get also cash or cash equivalent, and then you can pay the taxes. But with the exit taxation, you didn't get anything, so you need to kind of finance the taxation. And there are, of course, some rules that you can pay in installments, but only if you give some security to the tax authority and so on. It's not, once you have to pay it, you kind of need to pay it. But of course, it's best to structure the company in a way to avoid this exit taxation. It's not always possible, to be real honest. If someone is holding just 10% in the company, then there is no power to change the company structure to avoid this exit taxation. And this exit taxation is, I think, for a lot of my clients a real problem and needs a lot of tax planning to avoid that.
Gotcha. Thank you. Melina, if anyone wants to get in touch with you, what's the best way to do so?
You can find me at LinkedIn, but I think the best thing is to write me an email. I'm always in Zoom meetings and other meetings. Best to contact me via email. And I'm sure you will share my contact details so that everybody has my contacts. But I think that's the best way.
Fantastic.